All right, thank you very much. Very excited to be here with these wonderful speakers. So I heard the panel was on passive versus active, and we used to teach this, we still do at some level. And I'd just like to start our panel with just a simple question to see where you guys stand in the passive versus active debate. And in particular, if you were to advise kind of a long-term investor now starting to save, say, for retirement, if you want to think about a portfolio, would you advocate for mainly sort of a classic stock picking active type fund? Would you advocate for factor exposures, low cost? Or would you advocate for just stick to an index fund?
So I'm here representing the passive side of this discussion.
To my left.
And quite frankly, I'm a little shocked we're still even debating this topic. If you've seen the recent SPIVA study, the Standard & Poor's Index versus Active study, they just came out with their 15-year study. 95% of mutual funds in major asset classes underperformed their index over a 15-year period. 1/2 of the funds that started out 15 years ago are out of business or merged into another fund. When you throw in the element of luck, okay, and this is something that few people think about, if some manager beat their index, was it just a chance outcome or a lucky bet on concentrated investment? It turns out that that's almost always the case. 99.4% of mutual fund managers in one major study looking at 2,000 mutual funds did not have what was deemed genuine stock picking skill. Now, if you don't believe any of that, I've been passing out some of my books. You can read on my website. It's the reason Eugene Fama earned a Nobel Prize for his efficient market hypothesis. Active managers are basically working under the market failure hypothesis, that markets don't do a good job at setting prices. If you have 10 million people trading every day, half of them buyers and half of them sellers, trading some 10 billion shares a day, that is a processing system that brings in the opinions and information of 10 million people every day. And that's why they do an excellent job at discovering what's a fair price. And when prices are fair, the only source of more return is taking more risk. So then it just becomes a question of how you can most efficiently, at the lowest cost, lowest amount of tax, own buckets of risk. And when they were talking about market cap weighting or not, you can easily handle that by designing an allocation of market cap weighted indexes that are large cap, small value in the US. You can do the same thing in international markets, emerging markets. We typically put together 15 different indexes with associated funds that track these indexes and design portfolios for thousands of clients. We manage about $3.25 billion with 2,200 clients, mostly that come over the internet, mostly engineers, doctors, and lawyers. Those who really want to dig into the information end up with an index-only portfolio. The first proposal for an index fund was called an unmanaged fund. Went back to 1960, okay? You have a financial services industry that makes money from trading, okay? When you're an indexer, you hardly ever trade. So the financial incentive to get the story out on indexing was basically zero, okay? Eugene Fama wrote his paper in 1965 about efficient markets. This story goes back to Adam Smith, goes back to Hayek. When you have millions of people trading with a number of assets out there, they do a very good job at setting the fair price. When prices are fair, you basically have no opportunity for active managers to win other than by luck. Basically, you have to look at the alpha, the standard deviation of the alpha, and how large of sample size you have. And once you do that, basically all alpha go away.
To you then, is there a sense that lower fees and more investor flows also equals lower premium for the factors? Is that something that concerns?
No. Listen, Fama and French wouldn't have concluded these were risk factors unless the returns are basically unknown and highly variable. I think we just finished almost a 10-year period where small value tilt did not help the investor. Mm-hmm. And in the last 2 months of last year, it came roaring back. So these, the excess return for small and value and now profitability, those returns must be random, unpredictable, and long periods of non-existence. When things are predictable, in other words, next year you're going to get a 20% return with 100% certainty, the seller of that investment requires a higher price, then the premium goes away. But when the premiums are uncertain, they're pervasive across different countries, pervasive across long periods of time, then you can expect an excess return there, but you can't expect it all of the time.
Is sort of quantitative investment going to just take over 100%? What do you think is the role for sort of the old-fashioned financial analyst and fundamental value investor? So,
you want me to answer that? Well, I'm not sure, when you mean fundamental value investor, so they're analyzing the data and trying to find mispriced equities,
or some undefinable gut feeling that, the star,
Yeah. So. The gut has not served investors very well, unfortunately. The Dalbar study has been heavily criticized, but they routinely come back and say the average investor only gets about 4% a year, while the S&P is doing 10% a year. They just came out with a 30-year study just the other day. So there's, I think, zero opportunity for individuals to go out and speculate and try to find mispriced investments in publicly traded markets, and with a hope of trying to do better than some risk appropriate index fund. What you're really chasing is luck, and luck doesn't persist. There was a major study done of institutional investors. They looked at the hiring of almost 9,000 investment managers. What they found is for the 3 years prior to being hired, the average fund that was hired outperformed their benchmark by about 3% a year. Now, if that was skill, after they were hired, we'd expect that to continue. But instead of continuing, they underperformed their benchmark basically by the transitional fee cost, which is about 0.5% a year, for the following 3 years. So a 3% alpha went to 0. That alpha is nothing but random chance luck, and people perceive it as being skill. The investment managers package it up and sell it to you as if it's skill. So chasing performance, even that phrase is a misinterpretation of what's going on. People are just gambling. Occasionally they win. Everybody wants the past winnings. Now, Josh talked about that some people can still do well beating the market. Again, it's luck. We haven't got to this question yet, but it reminds me of this question. So, what's going to happen if everybody indexes? It will never happen. We have a human condition called the prediction addiction. We want to make predictions and we want to bet on them. It's human nature. And we like to say when they decide to dynamite Las Vegas, because nobody wants to gamble anymore, that's when you can start worrying about whether passive investing will ruin the market. It's not going to happen. So first of all, the reason market timing is so hard is the exact same reason that stock picking is so hard. The winners are very highly concentrated. In the average year, it's about 4 or 5 days that make up the entire return for the year. The S&P is about 10% a year, We get some 2 and 3% days throughout the year. If you're not invested during those days, you didn't get your 10% a year, okay? Now, there's all kinds of other ways you could invest throughout the day and randomly come out and still get your 10%. But the concentrated returns that show up in the bell curve, that's why we have the random walker. The results that show up in the tails are basically all of the action. And the reason we diversify, hold all the stocks, and for as long as we can, is so that we capture those tail events. Now, unfortunately, you get both sides of the tail, okay? But you cannot miss out on the positive. And if you have the whole distribution, on average, you get the average. What the random walker actually shows you is that all expected returns start in the middle. That's caused by changing prices. So here's a brain twister for you. Why do prices change? Prices change so that the expected return stays the same. Can I say something about hedge funds?
You can, man. Sure.
So who read the Warren Buffett Berkshire Hathaway shareholder letter that just came out? Oh, well, maybe I don't even have to tell the story. Warren, 10 years ago, he put a bet out there. Does anybody want to bet that they can find hedge funds that'll beat the S&P 500 over the next 10 years? Well, almost 10 years have gone by. I think the average of the 5 hedge fund portfolios that were assembled is something like a total return of, 35%, and the S&P had a total return of 85%. So about 15 years ago, William Bernstein wrote an article called The Big Lie. The big lie was that there were some components of the market that were inefficient, which you quoted in your question. I was just looking at the SPIVA study. People often quote emerging markets, okay? 90% of emerging market equity funds underperform their benchmark. International equities, 89% underperform their benchmark over 15 years. When there's a publicly traded market, they're all efficient. That is your best assumption to make. And if I were you, I would index that entire portfolio.
Somehow I guessed that. Yeah, one more question.
I'm Suzanne Moline, and I feel kind of uncomfortable admitting this, but I work for a hedge fund, so I feel very unpopular. But I actually specialize in looking at micro cap stocks. So here's a question for you as sort of more money flows into passive investing. Here's something that I've seen literally at some companies I'm looking at right now. So you have these micro cap companies, tiny little companies, and you just don't see the best management. I mean, sometimes you see stuff that's pretty egregious, just like gross value destruction by management. And when you look at the biggest shareholders, you have a bunch of passive investors who this is like a drop in the bucket of their portfolio. Nobody's paying attention, nobody's holding management accountable, and it's just really sad. So what do you think about that? But I'm interested in what you have to say about it, yeah.
Yeah, so first of all, markets are efficient. If you look at the small cap core portfolio as an asset class, 95% of managers underperform their benchmarks. If you go to small cap growth, it's 99%. That is the definition of efficiency when all these managers cannot find mispriced investments. Now, Roger Trinworth is back there. Raise your hand, Roger. Roger's from Dimensional Fund Advisors. How many have heard of Dimensional Fund Advisors? Okay. That's where you want to work when you get out of here. That is the premier investment firm in the world as far as I'm concerned. They started the company with the bottom 20% of all stocks weighted by market capitalization, which was called the 9-10 fund, which was the microcap fund.
Which is an active bet.
So it's not an active bet. It's a passive holding of risky assets. You heard her define the ultimate risk. These companies are mismanaged. What they really end up having is what's called a high cost of capital because their future returns are so uncertain. The cost of capital to the firm is the expected return to the investor.
Okay, but so just backing up from we know you're not going to invest any money in an activist small cap fund manager, but from a systemic point of view, do you see what I'm saying? I'm asking about it, shareholders sort of holding management accountable, or we don't care if
So
they just sort of
that's-
destroy value and go bankrupt, and
That's the function of the board of the company.
yeah, well,
Right.
Right.
Well, so first of all, very few companies last forever. If you look at
Yeah.
the original S&P 500, you go 40 years later, there's only 75 left, okay? This is creative destruction.
okay.
And so the ones that are doing it right will grow into a mid cap or a small cap, whatever's next, and ultimately large cap. And those that don't, go away. And
Okay.
but that is a great place to passively own that asset class in the small cap arena. The average returns, what are they, about 12.5%? Something like that for 89 years versus a 10% large cap. And that's because they're riskier.
Yeah, they're definitely riskier.
It's a passive holding of a risky asset. It's not considered active. Go ahead, question?
My name is Alan Risch, and I graduated from UCLA, the Graduate School of Management, so long ago that my investment professor was Benjamin Graham. After he retired from University of Chicago. My question is, when you compare, and Meb says a little bit about it, when you compare your returns, my advisors always show me, the various index and then what my actively managed funds do, but they never consider the taxes. And in a good market, I end up paying a lot of taxes, even though I might be doing a little bit better than the index.
This is a major problem. It's one of the reasons that you passively hold your portfolio so you don't have capital gains tax